Hey everyone, welcome back to Corporate Decoder, the place where we crack open those confusing corporate filings. Today we're diving into Schlumberger's latest 10Q report. Are there stormy financial seas ahead or smooth sailing towards bigger profits? Let's find out. This isn't just another company. Schlumberger, or SLB as it's also known, is one of the biggest names in the oilfield services game. They help oil and gas companies find and extract resources around the globe. So their reports give us a peek into the health of the energy industry as a whole. This report covers the first 3 months of 2025, so we're getting a fresh look at how they kicked off the year. Alright, let's get right into the numbers. The most interesting part of these filings. First up, total revenue. $849 billion. That's down from $7 billion in the same period last year. So Schlumberger is making almost 1% less money in 2025 compared to 24. It's not a huge difference, but it's something to keep an eye on. Now, what about profit? That is the money the company gets to keep for itself. Here we see net income attributable to SLB at Trasom 797 million. That's a notable dip from Fossinon's 68 million in the first quarter of last year. So they're taking home less profit of last year. So for every $100 they made, they got to keep less of it compared to last year. Another key number is diluted income per share of SLB, which is 0.58. That's also down from 7.4 last year. Earnings per share helps investors know how much money each share of the company is making. So again, not good news for investors. It means if you hold some of the stock, you will be making less than before. Now let's jump to the cash flow statement, which is another very important financial metric. It describes how cash actually comes in and out of the business. We see net cash provided by offsetting activities at $660 million. This means the business is bringing in less cash than it was last year, which was roughly 27 million. This means the business has to find other means to fund itself if there's not enough cash generation, and that hurts investors. Now, there are also capital expenditures are also called CapEx. Those are things like machinery. Capital expenditures clock in at Tenxam 398 million. Those are similar to last year, so the company is not investing more or less in its equipment. This means the cash from operations decline is not compensated by a change in spending. The cash end of period to end with is 36 million, which is again down from last year. So overall, a pretty dire situation when it comes to comparing it to last year. Alright, now let's touch on stock information for those investing. The line treasury stock, which is stock a company buys back from the open market, giving it back to itself, decreased. More specifically, it's down 300 million year over year, which might indicate that the stock will now be less stable since there is less available stock. Checking the balance sheet now, liabilities have also increased to 254 million versus last year, while equity has decreased to about 48 million. This is not good and generally shows that investors are pulling out of this stock. To make things worse on shareholders, the report shows the company bought back tanks of 100 million of stock for the stock repurchase program. Companies do this to return value to shareholders. Although on the surface that looks like a good thing, stock buybacks can inflate the price of a stock, a tactic that a company may employ to artificially increase value, rather than having the value increase on its own from the company's underlying business model. Okay, those are the numbers. Now let's put them together for the big picture and understand what it all means. SLB's first quarter looks a little shaky. Revenue's down slightly. Profits have taken a bigger hit and cash flow is weaker than last year. They're also spending a lot on buying back their own stock, which some might see as a way to prop up the price. Now, let's take a peek at what keeps SLB's management up at night. The report mentions ongoing impacts from the war in Ukraine, which messes with global energy supplies, plus things like changing government rules, competition from other energy sources, and even just plain old weather can throw a wrench in their plans. They're also spending money to reorganize and integrate a recent acquisition, which could create some short-term pain. Also of note is SLB announced a definitive agreement to purchase ChampionX, but the integration may cause short-term issues. The all-stock ChampionX transaction may also dilute stock. This means you may have a slightly smaller piece of the pie. Okay, so we have seen the numbers and some risks, so let's take a look at the overall direction of the company. There may be a shift of priorities in the global economy, fluctuating commodity prices, evolving tariffs that may negatively affect their products. On top of those risks, the company's overall climate targets could suffer as well. So putting it all together, SLB is facing some headwinds right now, declining revenue and profits, increasing risk, and lots of external factors. A big concern is that they are spending a lot of money on these stock repurchases, which may be artificially propping up the price for investors. Still, SLB is a massive player in its industry and has a lot of expertise, so I wouldn't count them out. Thanks for watching this Corporate Decoder. If you enjoyed this video, please like, subscribe, and comment below.